product training, every week we learn about a new product, maybe sometimes repeated product. Today, I would be sharing some knowledge that you already have learned, the complete insurance package. Okay, I wrote here advisor masterclass, but this is not just for advisors, this is for everybody. So we will be learning about 3 pillars of insurance. Okay, so let's dive into, and we will see how those types of insurance that we already know, what we can learn more about them, and how to position those 3 types of insurance in the community under FISRA compliance. Okay, so let's start with, our focus today is very simple. Learn the fundamentals, be compliant, and be confident. These are the 3 objectives of the session. So let's dive in. Oh, what happened to my pillar? Okay, so if you see this pyramid, you can see that life insurance, financial plan, they are the base of the financial pyramid. However, wealth management is at the very top. What does that mean? That means in our life, protection starts with insurance. When we are protected, then we can think of saving our wealth. Now, insurance is for everybody, whether they have money or not. Wealth protection is for the people who have wealth. So that's the later stage after building the wealth. So we will be talking about the protection today, which is the insurance. Okay, so other things are in between. We need so many things to protect our life and our loved ones' life when we are not here. But insurance and wealth protection are the end goals of the pyramid. Okay, so as I said, protection, savings, wealth, transfer. These are the pyramid's steps. Now, 3 pillars of insurance. Term life insurance. We all have heard about them. Basic protection. Whole life insurance. Protection plus growth. Universal life insurance. Protection, investment flexibility. Okay, so we will go one by one through all of these things. So term insurance. We all know what is term insurance. Anybody want to explain what is term insurance? We have learned about term insurance, I think, on this stage 3 times already. This is 4th time, 101 so many times. What is term insurance? Yes.
Term insurance is, as we say, it's a basic protection.
Right.
For a particular term, be it for 10 years, 15, 20, 25, 30 or 35 years.
Yes.
And it's only risk protection. As in, during that term, if, God forbids, the insured were to pass away, then the beneficiary will get the face amount, like $1 million, $2 million, whatever they have insured the person for.
Mm-hmm.
And it's like, actually like renting the house. We pay the amount, and once we leave the house,
it goes away.
There's no cash value.
There's no cash value. So who needs term insurance? Everyone? Yeah. Okay. Let's say a person who is almost 80 years old. He has paid up his mortgage. He has good wealth. He has done estate planning. Do you think he needs term insurance? Yeah? Does he? Okay. As we said, term insurance is temporary protection for the term we select. Temporary insurance, temporary coverage, temporary needs. Temporary needs, for example, mortgage. Maybe when we are not here, within that term, when we are gone, who's going to take care of my kids' education? If my other partner, will he be able to pay the mortgage? What is going to happen to my car? So these temporary needs are covered by term insurance. Also, term insurance is the cheapest option, and This is, as I said, ideal for income replacement, mortgage, or anything. But yes, no cash value, pure protection. That is the term insurance. Now we talk about FISRA compliance. Being advisors, what we should explain, being clients, what you should expect. So, knowledge is power. If somebody is explaining term insurance to you, you have the right to ask questions. Disclose. Are we or any other advisors, are they disclosing renewal rates? Are they disclosing conversion options? Are we able to convert our term 10 into permanent, or we can renew it to another 10 years? When we renew it, is there any renewal rate, new fees, new premiums? So we, being advisors, need to disclose it, or others as clients need to ask it. Okay, conduct. We can't just go and sell term insurance to anybody until we have proper need-based analysis. Do they really need term, or do they need term plus anything, a hybrid coverage? So need analysis is really important under FISRA. We can't sell just term because we think it is good. Okay, avoid misleading premium projections. When we create an illustration, there's a long table in the illustration. If you guys, if as a client you receive it, or advisors, we know when we create it. That table tells us if we have term 10 and we want to renew it, at the end of term 10, what will be the premium? Okay, so we are not misleading. You know what? Take term 10. I will convert it. It will be like what? $10 extra? We'll watch it. No, we can't see. We can't project. We don't know what happens in these 10 years, if anything drastic, if there is any CI, DI they have to take. What is going to happen after 10 years then? So do not mislead or do not project any premiums. If you want to project, show them the document and tell them within these 10 years, if anything happens, premiums are not in my hand. We will see after 10 years what can happen. So these are the FISRA compliance guidelines when we are selling the term insurance. Okay. Now we already have done so many case studies. Let's do one more when we are combining everything together. Now Amit and Priya, a couple in their mid-30s. They have 2 young children and new home in Mississauga. They both work full-time and just signed a 20-year mortgage of $650,000. Maybe they are the one I should sold the house to.
Yeah, I was thinking too.
Yeah, like most young families, their biggest fear is what happens if one of us is not around tomorrow. So, what do they need? They just bought the house. They have a young children, not the age, but they have young children. Okay, now their biggest concern is what happens when we are not here tomorrow. Plus, they just got the mortgage. They may or may not have money. We can't say until need analysis, but this is the what we can see. Okay, so their high point advisors, they explained after need analysis that term 20 insurance is matching their mortgage period. If the amortization period is 30, they can buy term 30. Okay, now Amit took 500,000 policy and Priya took 250,000, each with 20 years term. Now they have the coverage of 750. That covers the mortgage of 650 and 100,000 is for their kids. Okay, this can be extendable. This is just the example. But when we have full need analysis, then we will know how much they exactly need, because we don't know if they have any investment property, if they have any other temporary insurance, employer insurance, we don't know. However, based on just this little scenario, this is what we can offer to them. Now the plan is cost effective, around $45 a month combined, because the term insurance, as I said, cheaper. 500,000, it's going to be like what, $25? And Priya is female, 250, it will be hardly $10-12. Okay, and they are very young couple. So yes, this will be income replacement and debt protection in case one of them is not around. Okay, so if tragedy strikes, surviving spouse can pay the mortgage, maintain children's school routine, or have time to heal without the financial pressure. Okay, now this shows client that term insurance is about peace of mind, not just about the premiums. In $45 a month, they both are covered and protected for 20 years. Okay, so this is the term insurance, temporary, short-term goals, and for young couple, this is just pure protection. No cash value, no investment, no growth. All right, whole life insurance. We already have discussed about whole life insurance. Second type of insurance is whole life, and we call it permanent insurance. Permanent insurance, and this permanent means whether you pay for, you have the option to pay for 10 years, 20 years, 5 years, 25 years. However, this insurance covers your life throughout the life. It's not temporary, and guaranteed cash value. And there are two type of whole life insurance. One is participating, that we call it par participating, and other one is non-participating. We have the option to choose which one. Participating whole life insurance means our premiums are participating in investment. The company we have taken the insurance from, they are putting our premium into investment, okay, and we are getting profits, dividends. Okay, so company profits are being shared, that's called participating. When they say non-participating, that means they are guaranteed, predictable. If the illustration tells you at the age of 60, if your value will be like what, 600,000, it will be 600,000 whether market goes up and down, and this will have nothing about the dividends we are getting. Okay, this is pure non-participating, guaranteed and predictable, but no company profits. Okay. Okay, now key benefits of whole life insurance: predictable premiums, tax sheltered growth, and dividends. We use dividends as paid up addition, cash or premium offset, it's all up to us. Paid up addition means the dividend which are coming. Let's say we paid for the policy, this is lifetime policy, but we paid for 10 years. Now, the question arises, if I'm paying premium only for 10 years, how am I covered for the whole life? How am I getting my company profit? Now, those are the dividends, and we have the option paid up addition. Paid up addition means the part of those dividends is covering the premium when we are not paying. So our premiums are being paid by the profit we are gaining, and we are still covered, cash value is still increasing, and we have profit anyways. Cash, we have the option to get the cash. Okay, so we select what we select, that we want dividend in hand. Okay, yeah.
So it's always sure that we're going to get profits in case the company has losses? What?
Yes, so no, whole life is, that's why this is called peace of mind. In the whole life insurance, company gives us guarantee
Of dividends?
of the, yes. So we have the if the company, let's say companies, the funds are getting in loss, we don't worry, we are getting profit. If the company says okay, we are closing, then you have to worry about. However, then we have government behind us, assurance, they will cover,
1 million.
and over that 95%, 90%.
So in participating,
Yes.
is the one guaranteed amount 6 lakh? That is the
one we
that
yes,
we have assured for.
That's
the group
right.
Benefit,
Yes.
That is guaranteed.
that is guaranteed.
But profits is the separate.
Profits is separate, yes. So dividends are, that's why the illustration that we create,
Yeah.
that we give, in the illustration it tells you, because when we buy the whole life, we have no choice to select the funds.
Yeah.
We don't select the funds, it is the insurance. However, company is putting that money into the investment.
So we cannot give them a guarantee of 10%, 5%, 6% dividend.
We can't guarantee, no, the clients we cannot guarantee, Being advisors, we cannot guarantee anything. We can suggest them, we can tell this is the illustration and this illustration tells. So we always select the percentage when we buy the policy. In the illustration, when we create the illustration in the software, there is 4% to 7% is the interest rate window, 4 to 7%. So we select that. So the dividends or investment profit or anything we are getting, it is from 4 to 7%. However, if we select, let's say, so that means if we select 5%, that doesn't mean 5%. The market goes up and down. Our document is telling this much we are getting.
We have to be conservative, right?
We have to be.
We have to be
But yes, but when you talk to clients, do not say, I guarantee in this age you will get this much of money. You can say, but then, anything. Well, as I said, the investment growth as a dividend is coming to you, and when they are coming, you are getting the statements. However, the guarantee word will come on you. Okay? Yes. But yes, we have guaranteed options in there still. Okay? Okay, and then we have the third option of premium offset. Premium offset means with the dividends, we can say, if I selected to pay premium for like 20 years, with the dividends, I will finish my payment in 10 years. Rest of the 10 years, my dividend will pay.
And participating policy will be having a higher premium than the non-participating, right?
The high premiums? Oh, yes.
Higher premium than
It will, yes, because
there's
investment part, that's right, and company profit, that's, yeah. All right. Okay, now in the whole life, what are the FISRA guidelines? We are presenting guaranteed and non-guaranteed illustration values both. Okay, this is what we are talking. Guaranteed and non-guaranteed illustration values we are giving to the clients.
So non-guaranteed is the profit.
Dividends.
Dividends.
And then we have par and we have non-par. When we are giving whole life insurance to the clients, we have to disclose everything and then suggest and then let clients choose with our suggestions and guidance. Okay, but yes, we have to disclose and we have to give all the options to the clients. Again, avoid overstating dividend scales. Overstating means we can't say that, okay, I have chose 4%, but there is the option of 7%. If I choose 7% interest, your dividend will increase. Or you chose 7%, your dividend can decrease. Okay, so do not overstate dividend scales because we cannot guarantee. Okay, we guarantee the coverage. We can guarantee the death benefit. All right. And obtain client acknowledgement on the projections. That's why we say always when we put the policy in, we should have illustration attached with that. That clients have reviewed the illustration, they agree upon, and that's why we are going ahead. Okay, so yes, always disclose and do not overstate because clients are trusting you. They don't know anything, they're trusting your words. Whatever you say, after 10 years, they're going to come after you. 10 years ago, you said that thing. Okay, so yes, know your limits and always trust on the illustration and the softwares that company has. Okay, tax and assurance. Assurance, we all know if company goes bankrupt or closes, assurance is here to protect us. And CRA, cash value inside the policy, that's growing tax sheltered. Okay, so these are the tax and so government is behind us helping our protection, our coverage and our investment no matter what. Okay, now case study again. Meena is a 42 years dentist and mother of 2. Wanted something beyond temporary protection, beyond term insurance. Her concern was building a lasting legacy and guaranteed savings for her children. Okay, now guaranteed savings. Guaranteed savings already triggers us to whole life because the cash value is guaranteed. How much? That's a different scenario. So she does not want term because she wants something beyond temporary, but she wants legacy and guaranteed savings. So we introduced a participating whole life policy. Now we introduced it for 250,000 coverage with 20 pay option. Premium will be paid in 20 years, and this created two benefits. Of course, lifetime protection that will never expire, guaranteed cash value that grow annually plus potential dividends. If we withdraw the dividends, then the investment will be different. If we reinvest the dividends, then the cash value will be different. Okay. Now, by year 15, Meena's policy has accumulated more than 60,000. So then she could access this money, and she can use this money for children's university tuition or supplement retirement. She has the option to take that cash value. Now when we take the cash value is a different scenario. How do we take it? But yes, she has the option to use those cash value of 60,000 in her different scenarios. She wants to use what she can use. So Meena now refers to whole life plan as her family wealth vault. It's her way of ensuring that no matter what, her children's future is protected and her money continues to grow even when she sleeps. Okay, now she doesn't worry about investment. She doesn't worry about what happens to the company, what happens to the market, what happens to the cash value. She has chosen her path. So she is worryless with the whole life. Okay. All right, now it comes to universal life. Universal life, we can't use word guarantee other than the death benefit. Okay. Universal life, we have flexible premiums, we have adjustable coverage, and we have with the life stages of the clients. Okay. Investments growth component is there in the policy. Now, what is the difference between whole life and universal life? Both have life coverage, both are permanent life insurance. And what's the difference between whole and universal life? And both are getting invested. Yeah.
Premiums, we have the ability to, it's very flexible. We can invest in different funds, and secondly, the premiums can be adjusted. As in, you can start with $100 a month. You can increase it to 250 or 500. In case of universal life, it's level.
It's okay. Yeah.
In case of
whole life. Yeah. Okay. Yeah. Anything else? Non-participating thing. Yeah. Company has nothing to do with profit sharing, right? Any more component? Investment.
You can choose the funds.
We can choose the funds. If we are giving universal life to anyone, they or the advisor should be smart enough who know how the investment works. Because in here, we are the one who are controlling the investment, who are controlling the funds. If market goes up and down, our value inside the policy fluctuates. If it grows, that's great. If it goes down, it goes down. That's, yeah.
After you finish, I have a question.
Okay. Okay. All right. Now the structure is COI. The components that are under universal life are COI and investment account. Okay. So cost of insurance and investment of the premiums. We have two options when we buy UL. One is level cost of insurance. Second is increasing cost of insurance. Increasing cost mean every year it increases. Okay. Now the people who want to grow money, who are risk takers, they can buy increasing COI, universal life insurance. Okay. Yeah.
Is there any guaranteed cash value in UL?
UL cash value is not guaranteed. Yeah. That's why it says flexible premium and adjustable coverage. Cash value, when does cash value become? When we have our funds, our investment is growing good. Then there is cash value. There is cash value. There may be more cash value than whole life, but it depends on the funds we have chosen.
Death benefit is guaranteed.
The one we chose is guaranteed, and then we can adjust our coverage.
So the basic death benefit remains
It's
guaranteed even in
it's
universal.
yes, yes. However, as I said, with the investment growth, it can be adjusted, but what we chose in the beginning, that stays.
That's
Okay, all right. So FISRA compliance again. Universal life is, we need investors profile when we buy this insurance. So whoever is controlling the component of universal life, they have to be good investor. If they are not good investor, the profile we choose, it won't be risk profile, it won't be growth profile, it will be balanced profile or just income profile. So under FISRA rules, we have to match the funds to clients' risk profile and their investment knowledge. We have to disclose management fees and COI variations because of the investment portion in the universal life insurance. And we have to very carefully document each and everything we talked to client in the very beginning. If client comes last to you and say you never disclose any management fees, if you didn't document, you have no evidence. If client said, we don't know. We thousands of clients come to us after 10 years, who remember we disclose management fees or not. So in universal life, we have to be very careful. We have to document every single thing. Okay.
excuse me,
Yeah.
in the COI variation, what is that COI variation, the FISRA?
Oh, sorry.
compliance,
Yeah.
Disclose management fee and COI variation. Cost of insurance variation.
Cost of insurance variation. In here, yeah.
Are you referring to YRT versus LCOI?
So COI variation can be, so as we said, there is one component of increasing.
Yeah.
One is level, one is increasing. So when we are disclosing them, we have to say, if it is level, it is level. If it is increasing, then cost of insurance will be variable. And also, when we have,
Do we give advice to the client whether he should go for YRT or LCOI?
we if you are certified advisor, financial advisor, you can advise.
Not as a insurance advisor.
We can advise, we can suggest, we can tell them, see, our job is to explain everything.
Yeah.
Right? However, we have this need-based analysis that we did. Now, need-based analysis at the end is advising.
Yeah.
On its
Show
own.
us that
Yeah.
This particular client should go for YRT or LCOI.
That, so when somebody, we can suggest them, we won't say you should take only this and not that. If you're advising, tell them why not. If I want you not to choose this, why not? If I want you to choose level, why level? Client will say, okay, I want to risk my money, I want to earn more money in my universal life. They can be a good businessman, they can be a good investor. Then you can't say according to me. You can tell them, this is the meaning, these are the plus and negative of level, this is the plus and negative of increasing COI. Now, let's discuss. Okay, again, document everything. If you started advising without any license, FISRA will say, how do you know? Okay, so they will ask each and every question, why? Why this, why not that? You should know client said that. Or why did I advise it? So document everything, or FISRA will be there to catch you. Okay. I think, yeah, we discussed it. CRA and estate, tax deferred growth again. Policy loans, as per the cash value, we can use it as collateral. We can give the policy as and take the loan against it. It is effective for corporate or high net worth planning. Okay, the people who have high net worth, who want to earn more money using UL, this is good for them. Okay, okay. Oh, I didn't use animation. So this is the case study. Raj, who is 50, he owns small IT consulting firm incorporated under his name, and he's looking for ways to build tax efficient wealth and protect his business in case of anything unpredictable. Now, advisor recommended universal life with $1 million coverage owned by the corporation. Now he contributes 1,000 per month, part of which goes to the insurance cost, COI, and the rest into the policy's investment account. In this case, he have chosen balanced fund option because he said he want to build tax efficient wealth and protect the business. He did not say he wants to earn money using UL. So now CRA and FISRA alignment. How did we advise 1 million coverage and how did we advise 500 here and 500 there? As per CRA and FISRA, investment grows tax deferred inside the policy. If Raj passes away, the death benefit minus adjusted cost basis flows into the corporation tax free. And the capital dividend account, CDA, is being used when we have corporation and when we have insurance on the corporation, then accountants know this CDA better. Now this will be distributed to his heirs efficiently. If there is no CDA, there's no point because that will stay otherwise. Okay, now Raj's UL plan become a strategic business tool offering protection, deferred growth and estate planning advantage. He later used the policy's cash value as collateral and for the business line of credit, a smart move that high net worth clients often they use it. Okay, all right.
Just one quick question.
Yeah.
Please explain adjusted cost basis.
Adjusted cost. Okay, so the so in the universal life we have cost of insurance and he have used 500 into the policy, but how much he is paying? 1,000. Now 500 is going into the policy's investment account. Now when he is putting the money into investment account, he has to withdraw this money. When he passes away, of course somebody has to withdraw the money. At that time this 500 is of course is guaranteed because that is going into his policy, but the investment part, that will be adjusted cost. Okay, now adjusted cost basis, that will be explained when it's the time of withdrawal. That's a long topic. We will
For calculating capital gains.
Yes.
we calculate that.
right, because when it is on the corporate taxes work differently than personal taxes.
Yeah.
Right, so this is the corporation insurance and he has used two different parts which will end into adjusted cost basis, ACB.
By going through corporate way, he has evaded that capital gain tax also because it is going to CDA.
It is going to CDA.
Yeah.
That's right.
So
That's why CDA is when we have anyone has corporate insurance,
Yeah.
CDA has to be there. If there is no CDA, then the insurance goes otherwise. It won't go to beneficiaries. Okay, because this is corporate and he's the key person, and who is Benny? Corporation. All right. Now, I think I took extra time. There is, we will discuss this later, that children whole life plan, and then RESP. When we are explaining whole life, I will again not go here. I will share the screenshot in the group. But when we are giving whole life insurance for the children, as per FISRA, we should explain RESP and whole life for children both. Some people choose whole life because it has cash value at certain time, and that money can be used for education, for mortgage, because that's their cash value. They are taking collateral against it or line of credit against it. So they can use this money for anything. However, RESP is specifically for education. If child does not choose to go to college or university, the money has to go to RRSP, or they withdraw, there are taxes, the government funding goes away. But anyways, we should explain everything and then let them choose whole life or RESP.
So the whole life is better than RESP then? If they have limited money to invest,
Well, if
the parents want to choose one of the two.
yes, then we have to tell them plus and minus of both. If it is only for children's education, parents may want, I don't want to take loan. If I'm buying the insurance, I don't want to take loan, let it go. I want the education money only. If they choose RESP, let them choose. But yes, we should tell them that there is a plus point, more flexibility if you buy the whole life for children, because there is the money you get can be used for anywhere, not just for education. However,
Protection is also not there in IRS.
it's not there.
Yeah.
In RESP, no protection, no insurance, money is money and government, but there is government grant, right? So it's the choice of clients. They want to choose education, let them. But yes, explain everything. So comparison table, I think we know enough about term, whole, and UL. I will share this screenshot as well in the high points group. So yeah, term is for young families and mortgage protection. Whole life is for estate planners, and UL for business owners and flexible investors. So we give the insurance to the client type, whichever fits best. So always, as per the compliance, always conduct need analysis, always disclose the product. We should always attach the illustration document, and we should always follow FISRA and Assuris guidelines. Okay. So yeah, do you have any questions apart from long section?
It was really nice.
Okay, thank you so much.